At first glance, trading looks like a battle between you and the market. Charts, levels, indicators, volatility, and patterns flashing in front of you. But if you look deeper, you'll discover that the real conflict is never on the screen. It's inside you. Every tick challenges your patience, every reversal tests your beliefs, and every opportunity exposes what you truly understand about risk, uncertainty, and personal responsibility. The market doesn't come after you. It simply reveals what's already there: your fears, your impulses, your expectations, and your unresolved need to control outcomes that can never be controlled. The inner game begins the moment you place a trade. Before that, you can stay theoretical, safe, and idealistic. But once you're in, once real money is at risk, your mental framework is exposed. If you've built that framework on hope, you'll cling to losing trades. If you've built it on fear, you'll cut winners before they ever have a chance to develop. And if you've built it on illusions about certainty, you'll find yourself frustrated over and over again, trying to extract guarantees from a system that offers none. Mastering the inner game means accepting that trading is not about predicting the future. It's about responding to the present. It's about aligning yourself with the flow of probabilities instead of resisting them. The market rewards those who can act without hesitation when their edge appears and detach emotionally when it doesn't. That kind of detachment isn't coldness, it's clarity. You stop trading to avoid pain or chase excitement. Instead, you trade because you understand your edge, and you trust yourself to execute it. To win the inner game, you have to strip away the beliefs that no longer serve you. Many traders approach the market carrying emotional baggage, memories of past losses, resentment toward missed opportunities, or pride from lucky wins that were never the result of true skill. These emotions distort perception. They turn neutral market activity into personal drama. When that happens, you're no longer trading the market. You're trading your own fears and fantasies. The inner game is about freedom. Freedom from the need to be right. Freedom from the fear of being wrong. Freedom from the emotional swings that come from tying your self-worth to your trade outcomes. When you develop this internal balance, you stop forcing trades to work. You stop demanding certainty. You stop interpreting randomness as a message about your abilities. Instead, you become a participant who flows with the market rather than fights it. Ultimately, the trader who wins is not the one with the best strategy, but the one who has mastered himself. When your mind becomes stable, disciplined, and aligned with the true nature of the market, consistency becomes possible, not because the market becomes easier, but because you stop making it harder than it is. The real battle in trading is internal, not external, because every decision a trader makes is filtered through the lens of their beliefs, emotions, and psychological conditioning. The market itself doesn't challenge you with intentions or motives. It simply expresses movement, price shifting because of collective actions from participants across the world. But what you experience while watching that movement is entirely shaped by your internal state. Two traders can look at the exact same chart and see completely different stories. One sees opportunity, the other sees danger. One sees clarity, the other sees confusion. This difference isn't caused by the market, but by the mind interpreting it. That internal interpretation becomes the true battleground, because it dictates not only how you react, but what you believe you're reacting to in the first place. When a trader sits in front of the charts, they're not just looking at price, they're looking at themselves reflected in price. Fear might show up as hesitation, preventing action, even when the setup is clear. Greed might show up as oversized positions that distort the emotional balance needed for rational execution. Hope might materialize as a refusal to exit a losing trade, as if the market owes you a reversal simply because you want it. Each of these emotional responses is born from internal narratives formed long before entering the trading world. Childhood lessons about winning and losing, past experiences with money, deeply ingrained fears of failure, the need for validation, the discomfort of uncertainty. These internal dynamics surface with tremendous force the moment a trader risks capital. The external market becomes a canvas upon which the internal self projects all unresolved conflicts. This internal battle becomes even more apparent when a trader attempts to follow a well-defined plan. On paper, everything seems straightforward: identify the conditions, enter at your level, place stops, manage risk. Yet, when the moment arrives, many traders fail to follow their own rules. They find reasons to delay entries, move stops, cut profits early, or revenge trade after a loss. None of these failures are caused by the system itself. The system didn't change, the market didn't suddenly develop emotions. The trader did. The friction isn't in the methodology, It's in the internal resistance that emerges when beliefs about uncertainty clash with the reality of risk. This is why so many traders spend years searching for better indicators, more precise signals, and perfect strategies when the real obstacle is never the technical approach, but the inability to align behavior with intention. The internal battle intensifies when randomness plays its role. A trader can follow all rules, execute flawlessly, and still experience a losing streak. The market is probabilistic by nature, but the human mind is wired to search for patterns, causes, and meaning even when none exist. When a trader expects certainty, every loss feels like a personal attack or a sign of inadequacy. Instead of accepting randomness, they internalize the outcome. This emotional weight leads them into spirals of fear-based hesitation or impulsive attempts to make back what was lost. The market didn't create this spiral. The trader's internal relationship with uncertainty did. Those who don't resolve this relationship remain stuck in cycles of self-sabotage, repeatedly losing not to the market but to their own reactions. Another dimension of the internal battle is the belief system traders bring to the charts. Some enter the market with unrealistic expectations, believing they can double their account quickly, avoid losses, or extract consistent profits without emotional discomfort. When the market contradicts these expectations, frustration emerges. That frustration then fuels blame, excuses, and a refusal to confront the true issue, the mismatch between internal expectations and external reality. Beliefs shape perception, and perception shapes action. If your beliefs about the market are flawed, your actions will inevitably follow that flawed blueprint. This is why the internal battle is not a single confrontation, but a continuous process of examining and reshaping the assumptions through which you interpret market behavior. Self-image also plays a major role in this internal conflict. Many traders subconsciously tie their self-worth to their trading results. A winning day feels like personal validation. A losing day feels like failure as a human being. This connection turns the market into a mirror, reflecting not just price but identity. When self-worth is tied to outcomes, the emotional stakes of each trade become enormous. A simple fluctuation in price becomes a threat to one's sense of competence or intelligence. This emotional pressure overwhelms the rational decision-making required for trading. The trader begins to act not to execute a plan, but to protect their fragile sense of self. This is not a battle with the market. This is a battle with one's own internal narrative about who they are and what it means to win or lose. Control is another battlefield. Humans crave the illusion of control, especially in environments filled with uncertainty. The market offers no certainty, yet traders often behave as if they can force outcomes by holding longer, adjusting orders, or avoiding stop losses. This illusion is comforting but dangerous. When the market moves against them, the internal conflict grows. The need for control collides with the undeniable reality that control doesn't exist here. The result is frustration, emotional overreactions, and repetitive mistakes. The market isn't fighting the trader is fighting the natural conditions of a probabilistic environment. The internal struggle is born from resisting the nature of the game rather than aligning with it. Another layer of the inner battle involves perception of opportunity and threat. Two trades with identical technical setups can evoke drastically different emotional responses depending on recent experiences. After a loss, the same pattern might feel risky. After a win, it might feel overly attractive. These shifts do not come from changes in the pattern itself, but from internal emotional states. When emotions dictate perception, the trader loses the ability to see the market neutrally. They begin trading their mood instead of their edge. This internal instability causes inconsistency, and inconsistency becomes the gateway to doubt, hesitation, overtrading, and the belief that something external needs to be fixed. Perhaps the most powerful part of the internal battle is the tension between potential and behavior. Many traders know exactly what they should do: manage risk properly, wait for high-quality setups, remain disciplined. But they don't do it. This gap between knowledge and execution isn't a skill problem, it's a psychological one. Fear of missing out, fear of being wrong, fear of loss, desire for quick results, all these internal forces override logic. The trader becomes trapped in their own emotional patterns, repeating actions that sabotage them even when they know better. And unless this internal conflict is addressed directly, no strategy or system will bring lasting success. In the end, every chart, every trade, and every outcome brings the trader face to face with their inner world. The market merely exposes what already exists within them. The true challenge is not conquering the market, but understanding and mastering the internal forces that shape decisions long before the click of a button. Emotions distort market perception and decision-making because the moment money is at risk, the brain shifts from objective analysis to self-protection. Trading appears logical on the surface, patterns, probabilities, risk management, and setups, but underneath all of that lies a deeply emotional experience. Every price movement, no matter how small, interacts with the trader's internal fears, desires, and expectations. These emotions then color the way the trader interprets information. A chart becomes more than a chart, it becomes a projection screen for anxieties, hopes, and unresolved beliefs. When emotions take over, the trader stops seeing what is actually there and starts seeing what they fear or wish to see. This distortion can happen subtly or dramatically, but in either form it overrides rational thinking and leads to decisions that conflict with the trader's own plan. Fear is the strongest emotional force that affects perception. When fear is triggered, fear of losing, fear of being wrong, fear of missing out, fear of giving back profit, it narrows the mind's focus. Instead of seeing the whole structure of the market, the trader becomes hyper-aware of individual price ticks. A slight retracement feels like a full reversal, a small wick feels like a threat. A normal fluctuation suddenly appears dangerous. The trader is no longer responding to the actual conditions, they are responding to the emotional meaning they assign to those conditions. Fear makes the market look more volatile than it is, more hostile than it is, and more unpredictable than it is. In reality, the market hasn't changed. The trader's internal state has. Greed distorts perception in a different way. Greed is not simply the desire for profit, it is the emotional exaggeration of opportunity. When greed takes hold, the trader begins to see potential everywhere. Every candle looks like the start of a trend. Every pullback looks like a perfect entry. Every consolidation looks like a breakout about to happen. Greed makes the market appear full of easy money, even when conditions are choppy or uncertain. It leads traders to increase position sizes, take impulsive trades, and ignore risk under the influence of greed. The trader no longer sees the actual probability of the setup. They see the reward they dream of collecting. What looks like opportunity is often nothing more than emotional projection driven by impatience and desire. Hope distorts perception by creating emotional attachment to outcomes. Instead of observing the market neutrally, the trader begins to root for a certain direction. Once hope enters the mind, the trader becomes blind to opposing signals. A losing trade begins to look like a temporary pullback. A clear reversal suddenly seems like noise. The trader finds excuses to stay in the trade, interpreting every candle in a way that supports their wish for recovery. Hope shifts perception from objective observation to emotional justification. The trader stops seeing probability and starts seeing possibility. Possibilities are infinite, but probabilities are not, and this confusion often leads to deeper losses, prolonged suffering, and impulsive decisions made in the heat of emotional discomfort. Frustration is another emotion that alters perception. When a trader experiences repeated losses, missed entries, or failed breakouts, frustration begins to cloud judgment. This emotional pressure builds like steam, pushing the trader to find relief through action. Under frustration, the market appears unfair, unpredictable, or purposely difficult. Normal patterns look manipulated. Normal consolidation feels like obstruction. The trader begins to interpret the market as something personal. This distortion is dangerous because it leads to revenge trading, entering positions not because they align with a strategy, but because the trader feels the need to get back what was lost. When frustration filters perception, clarity disappears, and the market becomes an emotional enemy rather than a neutral environment. Overconfidence also distorts perception. After a series of wins, a trader may begin to believe they have mastered the market, misunderstood randomness as skill, or believe they can predict price with exceptional accuracy. Under overconfidence, risk appears smaller than it really is. Patterns appear clearer than they actually are. Warning signs seem insignificant. The trader begins to ignore setups that don't feel exciting enough, or worse, overtrade because every chart seems to offer a valid entry. Overconfidence collapses the trader's risk boundaries and replaces them with illusions of control. This distortion blinds the trader to dangers they would normally recognize, leading them into drawdowns that surprise them even though they were predictable under the lens of probability. Attachment to past results also affects perception. When a trader recalls a recent painful loss, the mind tends to anticipate similar pain in the future. This emotional memory shapes how the trader interprets new opportunities. A valid setup becomes intimidating. A clear breakout appears suspicious. A simple retracement looks like a trap. The emotional residue of past mistakes transforms the neutral market into a psychological threat. On the opposite side, attachment to past wins can cause the trader to force trades that resemble previous successes. Even if the conditions don't match, the trader sees what they want to see, hoping to recreate the emotional high of winning. Both past pain and past pleasure distort present perception, pulling the trader away from objective decision-making. Expectations are another subtle emotional force that warp perception. Traders often enter the market with predetermined ideas about what should happen. When the market behaves differently, the trader experiences internal conflict. Instead of adjusting, they try to force their expectations onto the chart. They interpret ambiguous signals as confirmation. They ignore contradictory information. Expectations compress the trader's perceptual field, making them blind to neutral data that doesn't align with what they want to happen. This narrow focus prevents flexibility and blocks the ability to adapt, which is essential in a dynamic environment like the market. Emotions also distort timing. When a trader is emotionally charged, they either enter too early or too late. Entering too early often comes from excitement or fear of missing out. The trader sees a potential move and projects it forward, anticipating a breakout before it actually forms. They act on what they imagine, not on what is. Entering too late comes from hesitation or fear of loss. The trader waits for extra confirmation, not because the strategy requires it, but because their emotions demand it. By the time they enter, the edge is gone and the trade loses viability. These timing errors are not caused by lack of skill, but by the emotional distortion of perceived opportunity and perceived risk. The most powerful emotional distortions occur when traders tie their identity to trading outcomes. When winning equals competence and losing equals failure, perception becomes deeply biased. The trader doesn't evaluate setups, they evaluate themselves. They don't measure market risk, they measure personal worth. The emotional burden of this identity attachment alters everything they see. A simple fluctuation becomes a judgment. A stop loss becomes a personal attack. A missed trade becomes a flaw in character. This emotional weight distorts perception so severely that the trader loses the ability to think in probabilities. Instead, every trade becomes a psychological test, a moment where the trader's self-image is on the line. All these emotional distortions accumulate and reinforce each other, creating a mental environment where clarity becomes rare. The trader is not fighting the chart, they are fighting the emotional interpretations of the chart. The market is neutral, but the mind is not. The market offers movement, but the mind gives meaning to that movement. And when that meaning is rooted in emotion instead of objectivity, the trader sees something that doesn't exist, reacts to things that aren't real, and makes decisions based not on what the market is doing, but on what the emotions are telling them it means. Freedom comes from detaching self-worth from trade outcomes. Because the moment a trader ties personal identity to wins and losses, every fluctuation in price becomes a judgment on who they are. Trading then stops being a probabilistic activity and becomes an emotional battlefield where the trader feels constantly assessed, tested, or exposed. When self-worth is tied to results, the stakes of every trade become inflated far beyond the monetary risk. A small loss feels like humiliation, a missed opportunity feels like failure, and a drawdown feels like personal inadequacy. Instead of viewing trading as a series of independent events governed by probability, the trader views it as a reflection of their competence, intelligence, or capability. This emotional burden distorts perception, paralyzes decision-making, and disrupts the neutrality required to operate consistently. When a trader is internally free, when they no longer need the market to validate them, they gain a level of clarity that few ever reach. Neutrality becomes possible because the outcome of a trade no longer carries emotional meaning. A win is simply a positive result of following an edge. A loss is simply a natural part of the distribution. Without the emotional attachment, the trader isn't shaken by normal fluctuations. They don't panic when price moves against them. They don't feel euphoric when a trade goes in their favor. They remain steady, focused, and grounded because their identity isn't being challenged by every candle. This is the foundation of psychological freedom, the ability to observe the market as it is without projecting personal stories onto it. The trap of tying self-worth to trading often starts unconsciously. Many traders come into the markets with the belief that success equals competence and losses equal failure. Society reinforces this mindset from childhood, where performance is linked to praise, worthiness, or acceptance. As adults, these patterns persist. In trading, however, this mindset becomes toxic because the market does not reward correctness, it rewards alignment with probability. A trader can be skillful and still lose. A trader can make mistakes and still win. When self-worth is linked to outcomes, the trader cannot accept this inconsistency. They become emotionally reactive, interpreting randomness as a message about their personal value. This emotional interpretation leads to impulsive reactions that break the very consistency needed for long-term success. Freedom comes from recognizing that a trade result contains no moral content. A loss does not mean the trader is bad, foolish, or incompetent. A win does not make them brilliant or superior. It simply reflects the natural uncertainty of the environment. When a trader truly understands this, their emotional attachment dissolves. The market no longer feels like a judge. It becomes a field of opportunities governed by probability, unaffected by personal narratives. This mental shift reduces stress, increases patience, and restores the ability to follow a plan without emotional interference. Self-worth attachment often shows up subtly. Like the need to be right, traders who equate being wrong with personal failure will go to extreme lengths to avoid acknowledging a losing trade. They might move stops, add to losing positions, or hold through deep drawdowns simply because admitting the loss feels like admitting personal inadequacy. This behavior is one of the most destructive patterns in trading. It doesn't come from a flawed strategy, but from a fragile self-image. When the trader detaches self-worth from outcomes, the need to protect ego disappears. Taking a loss becomes as natural as exhaling. Closing a trade becomes a technical action, not an emotional confession. The trader no longer feels the need to defend themselves against the market because there is nothing left to defend. Detachment also enhances discipline. When outcomes don't define the trader, they no longer seek emotional comfort from trades. They stop chasing the high of winning or avoiding the discomfort of losing. Instead, they focus on execution. Execution becomes the only thing within their control, and it becomes the measure of success rather than profit. This shift changes everything. A well-executed losing trade becomes a success. A poorly executed winning trade becomes a lesson. The trader builds consistency because they are aligned with process rather than emotion. Discipline stops being a struggle and becomes a natural behavior because there is no emotional conflict between what the trader knows they should do and what they feel compelled to do. Freedom also opens the door to resilience. Traders who define themselves through outcomes often experience emotional collapse after setbacks. A losing streak feels like a personal crisis. Drawdowns feel like identity failures. This emotional weight makes recovery slow, inconsistent, and painful. But when the trader no longer attaches personal meaning to outcomes, setbacks lose their emotional charge. A losing streak becomes data. A drawdown becomes a signal to pause, review, or recalibrate. The trader can bounce back quickly because their self-image remains intact. They can analyze mistakes objectively without defensiveness, shame, or denial. This objectivity accelerates growth because learning becomes unhindered by emotional resistance. Detachment also enhances patience because the trader is no longer urgently seeking emotional relief through trading. When self-worth is tied to outcomes, traders often overtrade to feel capable or redeem themselves. They take trades that don't align with their system simply because the silence of not trading feels uncomfortable. Detachment dissolves this pressure. The trader becomes comfortable waiting because their identity is not threatened by inactivity. They don't feel the need to force results. They can observe the market with relaxed attention, choosing only to act when their edge appears. This patience is one of the most valuable psychological traits in trading, and it arises naturally when the trader's identity is no longer on the line. Another transformation occurs in the trader's relationship with uncertainty. Those who attach self-worth to outcomes often crave certainty because uncertainty threatens their sense of competence. They want confirmation, reassurance, or guarantees before acting. This need leads to hesitation, overanalysis, and missed opportunities. But when self-worth is detached from results, the trader can embrace uncertainty as the natural structure of the market. They no longer interpret uncertainty as a danger to identity. It becomes simply a condition to navigate. This acceptance allows them to execute decisively even without perfect information. They no longer need the market to behave in a certain way to feel secure. Detachment also brings emotional flexibility. Traders who tie identity to outcomes often become rigid, needing the market to conform to their expectations. When it doesn't, they become frustrated, overwhelmed, or reactive. Without the emotional attachment, the trader becomes adaptable. They can shift perspectives, respond fluidly to changes, and adjust their approach without emotional resistance. They no longer interpret unexpected market behavior as personal failure. They simply accept it as part of the landscape and adjust accordingly. In the absence of attachment, the mind becomes clearer. Clarity leads to better judgment, better execution, and better decision-making. The trader starts to experience the market as it truly is, not as an emotional extension of themselves. They become free to think in probabilities, free to accept losses, free to take profits without fear, free to follow their plan with consistency, and free to evolve without emotional barriers holding them back. Consistency is built on disciplined execution, not prediction, because the market is an environment of uncertainty where outcomes cannot be controlled, only actions can. Traders often enter the market believing that consistency comes from being able to forecast direction with high accuracy, as if success depends on predicting the next move. But prediction is an illusion that invites emotional instability. The moment a trader becomes attached to predicting the market's behavior, they tie their expectations to a future they cannot influence. When the market behaves differently than expected, which it inevitably will, frustration, doubt, and impulsive reactions take over. Consistency dissolves because it was built on the fragile foundation of anticipated outcomes rather than repeatable actions. Disciplined execution means acting on an edge the same way every time, regardless of emotional states, recent results, or temporary market noise. It requires accepting the probabilistic nature of trading, where even the best setups can fail, and even mediocre ones can succeed. When the trader focuses on execution instead of prediction, each trade becomes just another event in a long series. There's no emotional pressure, no need to force certainty, no fear of being wrong. The trader is simply following their process. Over hundreds of trades, this repetition creates statistical consistency, not because the trader knew what the market would do, but because they behaved consistently in the face of uncertainty. Prediction pulls the trader away from neutrality. It invites emotional bias. When the trader predicts a bullish move, they begin to see bullish signals everywhere, ignoring contradictory information. They hold losing trades longer because they want their prediction validated. They close winners too early because they fear their prediction might reverse. Their judgment becomes clouded by the need to be right. Instead of observing the market objectively, they interpret the market through the lens of their expectations. This distortion compromises every decision that follows. Being right becomes more important than being disciplined. But consistency cannot exist where discipline is compromised by emotional attachment to outcomes. Disciplined execution removes this emotional conflict. The trader no longer uses the market to confirm their beliefs or validate their predictions. Instead, they evaluate each situation based on predefined criteria. What is the setup? What is the stop? What is the target? What is the risk? When the criteria are met, they execute. When they are not, they wait. This detachment from prediction allows the trader to operate with clarity. The outcome of each trade loses emotional meaning, and the trader can act with the same mindset regardless of wins or losses. This is the essence of consistency. Not knowing what will happen next, but knowing exactly what you will do next. Many traders struggle with consistency because they believe they are inconsistent in method, but the real inconsistency lies in their state of mind. When fear dominates, they hesitate. When excitement dominates, they rush. When greed dominates, they over-leverage. When frustration dominates, they abandon rules. Prediction amplifies these emotional fluctuations because it attaches personal expectation to uncertain outcomes. Disciplined execution suppresses these fluctuations by anchoring behavior to structured rules rather than emotional impulses. The disciplined trader acts from a stable internal state, which naturally produces consistent external results over time. Consistency requires the trader to accept losses without emotional resistance. Prediction creates emotional attachment, which makes losses feel like failures. Traders then avoid taking necessary stops, modify risk parameters, or skip valid setups out of fear. But disciplined execution treats a loss as a natural part of the business. No resistance, no avoidance, no emotional burden. The trader executes the stop as planned, adjusts nothing impulsively, and moves on. This emotional neutrality keeps the trader aligned with the long-term statistical expectancy of their system. Without disciplined execution, this expectancy can never be realized because emotional disruptions erode the sample size before the edge has time to play out. When traders rely on prediction, they fall into the trap of searching constantly for certainty. They switch strategies frequently, obsess over indicators, and chase perfect signals. They believe that consistency comes from finding the right method rather than becoming the right operator. But certainty does not exist in markets. Every edge has a distribution of wins and losses, and that distribution only becomes meaningful through execution repeated with discipline. Consistency arises from accepting that there will always be losing trades, false breakouts, unexpected reversals, and periods of drawdown. Prediction fights this reality. Discipline embraces it. Disciplined execution also stabilizes emotional energy. When the trader stops trying to guess what will happen next, their mind relaxes into a more objective state. They observe patterns with greater clarity because they are not filtering information through the fear of being wrong or the excitement of being right. They become more present, more precise, and more capable of noticing subtle details in market behavior. Prediction creates mental tension and narrows perception. Discipline creates mental freedom and broadens awareness. This improved perception enhances decision quality, further increasing consistency without relying on forecasting. A trader who builds consistency on disciplined execution understands that their job is not to control outcomes, but to control behavior. Markets reward those who align their actions with probability. This alignment requires commitment to structure, repetition, and patience. It requires resisting the impulse to intervene when a trade is open, resisting the urge to adjust rules based on recent emotions, and resisting the temptation to chase trades that lie outside the boundaries of the edge. The disciplined trader understands that success is not measured trade by trade, but across a series. Prediction focuses on the next moment. Discipline focuses on the next 100. Over time, the cumulative effect of disciplined execution becomes evident. The trader experiences fewer emotional swings. They no longer panic during volatility. They no longer chase after trends out of fear. They no longer overtrade after a loss or become reckless after a win. They remain steady, methodical, and objective. Their confidence grows not because they can predict the market, but because they can rely on themselves to act consistently regardless of the market. This is the foundation of true confidence. The kind that doesn't crumble after losses or inflate after wins. Consistency built on disciplined execution becomes sustainable. It is not dependent on specific market conditions, temporary winning streaks, or high probability environments. It persists through trends, ranges, volatility spikes, and periods of stagnation. The trader becomes adaptable because discipline gives structure, and structure gives stability. Prediction anchors the trader to expectations that break under stress. Discipline anchors the trader to process that holds steady under any condition. Mastering yourself is more important than mastering the market because every decision made in trading comes from your internal state before it ever shows up in your strategy. The charts don't create hesitation, fear, or impulsiveness. The trader does. The market simply exposes what is already present within the mind. Without mastery of your internal world, even the best strategy becomes inconsistent. A trader may understand technical patterns, recognize market structure, and memorize risk management principles, but if their emotions override their logic, knowledge becomes useless in the moment of execution. The true battleground isn't on the screen, it is in the space between thoughts, reactions, and beliefs. Self-mastery allows a trader to operate with stability, clarity, and discipline, regardless of market noise, volatility, or unexpected outcomes. When a trader hasn't mastered themselves, emotions drive behavior. Fear shows up in the form of hesitation, premature exits, and avoidance of valid setups. Greed shows up as oversized positions, chasing price moves, and ignoring risk. Impatience creates trades that never fit the plan. Hope persuades the trader to hold losers longer than intended. Frustration leads to revenge trading and impulsive decisions. None of these emotional reactions come from the market. They come from unexamined internal impulses. The market is neutral, but the trader is not. Without self-mastery, these emotions hijack decision-making, turning a structured plan into a series of inconsistent reactions. Self-mastery means developing the ability to observe these emotions without allowing them to dictate actions. It involves understanding personal tendencies, identifying emotional triggers, and creating space between impulse and execution. When a trader masters themselves, they don't fight emotions, they acknowledge them and continue to act according to their rules. This internal separation allows the trader to remain aligned with probability rather than emotional distortion. Market fluctuations no longer feel threatening or exciting. They become information, nothing more. This neutrality empowers consistent performance because the trader is no longer swayed by internal turbulence. Mastering yourself also means redefining your relationship with uncertainty. Traders who have not developed internal stability often seek certainty from the market, expecting clarity where none exists. They want reassurance, confirmation, or perfect signals before acting. This mindset creates paralysis, overanalysis, and constant doubt. But a trader who has mastered themselves accepts uncertainty as an unchangeable part of the environment. They don't demand the market to provide guarantees. They operate with confidence because they trust their process, not because they know the outcome. This acceptance transforms indecision into decisive execution. It replaces anxiety with calm. It allows the trader to navigate ambiguity without collapsing into emotional discomfort. Another aspect of self-mastery is managing the ego. The ego wants to be right, and in trading, this desire creates destructive behaviors. Traders hold on to losing positions to avoid the emotional pain of being wrong. They avoid closing bad trades because doing so feels like admitting personal failure. They take unnecessary risks after a winning streak because they feel invincible. They resist changing their approach because their self-image is tied to their current beliefs. Mastering yourself means dissolving the ego's grip on performance. The focus shifts from being right to doing what is right. A stop-loss becomes a neutral event. A losing streak becomes information, not judgment. Feedback becomes valuable rather than threatening. When the ego is quiet, the trader stops fighting the market and begins to flow with it. Self-mastery also strengthens discipline. Discipline is not simply about following rules, it is about regulating emotional impulses that try to pull you away from those rules. Without self-mastery, discipline collapses under pressure. The trader might follow rules when conditions are calm, but the moment emotions intensify, the rules are abandoned. Impulse overrides logic. But when the trader has mastered their internal world, discipline becomes natural. There is no internal battle. There is clarity, focus, and alignment between intention and action. This kind of discipline becomes the backbone of consistency, allowing the trader to execute reliably across different market conditions. Mastering yourself also allows for true adaptability. Markets change constantly. Volatility cycles shift, trends evolve, environments flip from trending to ranging and back again. Traders who lack internal mastery often resist change, either because they are emotionally attached to what worked in the past or because fear prevents them from adjusting. They cling to old methods, hoping the market will return to familiar conditions. But self-mastery allows a trader to adapt without emotional resistance. The trader can analyze objectively, make adjustments without fear, and evolve alongside the market. Adaptability becomes possible because internal stability makes external change non-threatening. Self-mastery improves perception. When the trader is emotionally charged, their perception narrows. They see what they want to see or what they fear to see, not what is actually happening. Patterns appear where none exist, risks are ignored or exaggerated, opportunities are misread. But with internal balance, the trader sees the market clearly. They recognize genuine setups without projecting emotional meaning onto them. They interpret data as it is, not as a reflection of their hopes or fears. This clarity allows the trader to navigate complex environments with precision, improving decision quality and reducing avoidable errors. Mastery of self also enhances resilience. Drawdowns, losing streaks, missed opportunities, these are inevitable. Traders without internal mastery take these events personally. They interpret setbacks as evidence of inadequacy. They lose confidence, abandon systems, or become emotionally aggressive. But traders who have mastered themselves process setbacks objectively. They analyze, adjust, and continue forward without emotional collapse. Resilience becomes a natural state of mind because their identity is not tied to temporary outcomes. They trust in their ability to recover, refine, and progress. Ultimately, mastering yourself creates psychological freedom. The trader becomes free from attachment to being right, free from emotional reactivity, free from the need to force outcomes, free from fear-driven hesitation, and free from self-destructive impulses. This freedom allows the trader to operate with calm confidence, grounded awareness, and consistent execution. The market becomes a place where probabilities are navigated with clarity, rather than a battlefield where emotions wage war against logic.